Hi everyone, welcome to this new video on Trent Ltd. So in this video, we will be discussing Trent, which has been a darling of the retail investor for the last few years, but also it's been a value destroyer in the last couple of years. And we'll try to understand the story of this company in order to better understand if we could have prevented what happened in the last year or so, and where does this business go from here, right? To answer these questions, let's first dive into the industry in which Trent operates. So Trent is a retailer, right? In the consumer services industry, it is specifically a retailer and a retailer of fashion. And more specifically, if you think about it, it also operates a value fashion brand in terms of Zudio. What is organized retail? Organized retail is nothing but basically where you're selling your products through chain stores, through the physical or the online platforms. So physical will be mostly, there'll be malls, there'll be these street markets, and in e-commerce, it'll be the online, it'll be the e-commerce giants, or it also now it will be the quick commerce platforms, right? So this is the organized retail sector where these companies are selling their products, apparel, lifestyle goods, food and groceries through these mediums, right? This is the industry. If you look at the value chain of the industry, it's mostly hybrid, right? I mean, it's hybrid. Why? Because it's mostly linear, where the products are manufactured and then they go to the retailer, and the retailer will sell it to the end user, which is us. But the retail segment is kind of operating as a hub and spoke, where things can come in from from different manufacturers, fragmented manufacturing. They can come into the retail chain, and then it can go out either through the online platform or through the physical front, right? So this is what actually happens. There are the vendors, which are basically the manufacturers. There can be a private label contract manufacturer, right? So Zudio can have a private label converter, which will make the product for them. Then there will be the retail operator, which is Zudio or Trent, which will actually be responsible for opening stores and converting the footfall into transactions, right? There's also another layer of distribution surface. So Zudio, if it doesn't want to open its own store, or where would it open its own store? So the distribution would be in malls, for example, or the distribution could be through the online channel, right? If you look at the margins, clearly one thing is here that the margins of the distribution surface, such as malls, is clearly very rich as compared to the 8 to 18% and 5 to 15% on a general basis, right? So what this tells us is if everything is constant and you want to enter this industry, probably going into the mall business is a wiser decision, right? And what are the pinch points in this entire value chain? One of the interesting things in this value chain is if a retail operator is selling its own brand, right? It has a private label manufacturer and it is selling its own brand. They kind of have higher margins as compared to a multi-brand reseller. This would be something like Westside versus Pantaloons, for example. And especially in the value chain, in the value fashion segment. Why? Because in value fashion, refresh velocity matters a lot. And when you have the production in your own hands and you're not dependent on other brands, the refresh velocity can be faster and can be controlled, which impacts the footfall, right? Think of it this way, like you would want to go to Zara if you see, oh, there's a new collection in Zara, right? Let us go check it out. So this is one of the advantages which a retail operator would, like a Zudio, would have over Pantaloons. And also, yeah, like on the distribution surface, bigger brands will get a place in a new mall first as compared to smaller brands. They have the first refusal pass. The types of players in this industry, especially in fashion retail, you will see the value fashion players. This will be your Zudio, which is a brand by Trent. This will be Usta, which is a brand by Reliance Retail, which is currently unlisted, right? Value fashion is basically where the average selling price is under 1000 rupees. Um, in terms of mid premium, where the average selling price becomes 1500 to 5000 rupees per piece, the examples are Westside, the examples is Pantaloons, Lifestyle, right? So these are some popular names which, if you've gone out shopping, you would have seen. And then there's also the fast fashion global brands such as Zara, H&M, Uniqlo. Um, these are usually bigger square footage retail, bigger square footage shops. Usually you will see in malls, right? Aspirational ASP, right? So Zara, H&M, Uniqlo above 1000 easily, right? Above 2000 maybe. Um, so if we try to understand these subsectors in this industry, value fashion retail and mid-premium fashion retail become very important to us, specifically because the discussion is on trend, and 99% of revenue can be understood or is dedicated to these two sectors itself of trend, right? If we see value fashion retail, firstly, Zudio is leading. So Trent is the leader in here, where their market share is of almost 25 to 30%, right? But what's happened in the supply side is that our evidence, or when we see what has been the investments by various companies in this sector, what we see is aggressive simultaneous capacity addition by every major retail group, with productivity beginning to flatten in recent quarters as densification cannibalizes. Now, if everyone is opening stores that too next to each other, they're going to eat up into each other's growth, right? Returns at the format level have been attractive enough to keep inviting capital. Higher capital involves competition, right? And that's happening, and there is no supply discipline which has emerged yet. Okay. So this is a worrisome fact. Like, you wouldn't want to own a company, everything else being equal, you wouldn't want to be in a company or in a subsector where there is this kind of a supply side madness, where everyone is trying to throw in capital, everyone is eating into each other's business, right? You would rather be in an industry which is, for example, a monopoly, no threat of new capital coming in. You know, they're going to keep earning money for the foreseeable future, right? So in that terms, in terms of mid-premium fashion retail, Pantaloons is the leader, Westside, Lifestyle. So this is Trent is coming in at almost number 2 here, right? This, in contrast to value fashion, here the supply side is disciplined, right? Rationalizing at the slower growing end, Pantaloons closures, and then West Side is kind of expanding selectively, right? So returns are healthy enough to keep capital invested, but it's not flooding in, right? There is no incremental new entrant threat at the core format level. So this is so interesting, just seeing the what's happening on the supply side, uh, irrespective of demand. It's just so interesting to see how these two formats or subsectors are kind of different in their capital cycle, right? And now we'll go into the analysis of Trent itself. All right, so Trent is the arm of the Tata Group, which is operating the Westside, Zudio, and the Star Bazaar JV across India and UAE through a near 100% private label model, right? They are not selling products of other brands. These are all their own brands, which they are making through manufacturer deals, right? Interestingly, Zudio and Westside are almost making up 96%. of the revenues, right? These are both fashion retail brands, and that is why if you think of Trend, it's mostly a fashion retail company. Star Bazaar is coming up, but of course, it's hardly anything in terms of revenue. So let's think of Trend as a fashion retail company until and unless these other segments show at least 1 or 2% of revenues. In terms of the revenue trend, wow, you can see consolidated revenue, 46%. My goodness. Zudio, 6,983. Well, maybe we don't have the numbers here where the actual growth could have been seen for Zudio. Westside has been growing at a good 26%, not a bad growth rate as well, right? Zudio's revenue scaled roughly 4x over 3 years on aggressive store rollout, right? So a lot of revenue was expansion based. Growth engine remains intact. The slope is no longer steep. That's the important thing. Westside has also doubled in 3 years with a 24% growth, alongside a 25% YOY ramp in the online channel revenue. That's also good. So everything is in the mid 20s when it comes to Westside, right? And look at this. This is the story of the company. If I were to tell the story in one format or one metric, this is it. Zudio from 25% of the company became almost a 50% of the company in 2 years. This was the massive scale of the Zudio expansion which we saw through FY22 to FY24. And now this is plateaued, right? Yeah, so it's roughly doubled over 4 years from a quarter to nearly half. Westside has seeded mix to Zudio through the high velocity rollout, but now the mix is kind of stabilized, which we are seeing in these last 2 years numbers, right? Does this company have a moat? Does Trent have a moat? The platform says it has a narrow moat. A narrow moat. Why does it say it? The moat is primarily driven by intangible assets in the form of strong brand pull of Westside and Zudio. It has one moat source, supplemented by a scale-based cost advantage. So that's the second moat source, which is more supplemental in nature. These brands have demonstrated superior customer preference, evidenced by being named the fastest growing and more admired retailers in India. A ROCE of 37% and EBITDA growth significantly outpacing sales growth confirm the structural advantages. A brand is not a moat if it cannot attract a higher pricing power. Having a brand is not a moat. A bad brand is not a moat. But if people want to pay more for your brand just because it's your brand as compared to a similar product, that's a moat. And that's what these two brands have. A ROCE of 37%. You can have a moat, but it needs to also reflect in the numbers, and that is also being confirmed in the returns of this company. Well-capitalized competitors exist, right? But the Trend's agile supply chain and own brand focus create high entry barriers for replicating its unit economics. That is why there's the narrow moat call, right? It reflects the lack of 10-year historical visibility and the inherent fashion cycle risks. So this is the judgment on the moat of the company. I hope you liked this one specifically. Moving on now. Okay, we'll quickly discuss what's happening in the business in terms of key variables. Look at the store count. Everything is in green, right? But what's the interpretation from these numbers? Total network growth has held the 250 new stores per year mark, right? Zudio additions normalized below the FY24 peak, while Westside has accelerated to its fastest year of expansion ever. Look at Zudio, doubling almost for 2 years, 36 to 231%, 97%, 136%. This is stabilizing now. And on the other hand, Westside had the biggest gross addition year in FY26, right? So that's what is coming up in the numbers, and that's kind of reflecting the story of this company. What's happened in those two big years, FY23 and FY24, and now where the story is kind of coming towards. In terms of like for like sales growth, they had a big year in FY23, but after that, like LFL sales growth is not that special, right? So this is again pointing us to the story of the company where now the growth is not coming from LFL sales growth, right? Mature store productivity is no longer growing meaningfully despite a 30% footprint expansion, right? Um, Revenue per square feet, that's fine. Gross margin trajectory, it's gone down from 51 to 44. Why? Because Zudio has become popular, a big part of the revenue, and Zudio by nature is a lower margin business as compared to Westside, right? Just because it operates on the fashion retail side. So that's what is reflecting in the numbers, right? This is nothing new to us. This we know. This is just a reflection of that story. In terms of operating margins, this is interesting because margins have gone up from 14 to 15s to 16s to 18s now, right? This is a reflection of the operating leverage payout, where a lot of investment in capex was done in these initial years, which kind of had a hit on the margins. But now, as that has somewhat reduced, the operating leverage is showing up in the EBITDA margins. And ROCE obviously peaked in these 2 years, but now it's come down a little bit. Why? Because of two effects. Capex step up is happening from 500 CR to almost double now, and the softening incremental store productivity, right? Which is, so it's still above greater than 29%, which is good, but the incremental store productivity, the LFL has kind of relaxed. It's not really happening now, right? Where's the growth gonna come from now? There's going to be a Zudio tier 2, tier 3 rollout, which is going to be sustained at 200 net ads additionally. So Zudio is still expanding, not like crazy, but it's still expanding. Like 200 is Zudio stores, gross additions. Wow, it's going to maintain its FY25 and FY26 pace. Operating leverage from RFID and supply chain automation. This is the internal thing. And Westside re-acceleration with a 4x step up in net addition. Which we just saw that Westside is kind of picking up pace. So all in all, the base case with the medium confidence is coming to a 20 to 22%. Revenue is going to compound at this, which is mostly going to come from 200 Zudio plus 50 Westside net ads. So the growth is mostly going to come from more store additions, right? With a broadly flat like-for-like sales growth. EBITDA margins might expand to 20% by FY28 based on the operating leverage and the RFID and all the supply chain things which they are going. So the PAT could be around 22 to 25% CAGR, right? So yeah, this is the story of Trent, or this is likely where Trent is going to go into next, right? It's your call to understand whether this is just a pause in the story it was in, or is this a new phase of a company where this is going to be the new normal, right? It's not going to be crazy anymore. So that's your call.